So I think, of course, Marc, one, just good to see you. Thanks for coming down here to the conference. So we've seen really a euphoric market response in the days after the re-election of President Trump. I mean, you heard Tappan mention a new cast of characters. These new cast of characters coming into the administration, are they as market friendly as the market is pricing in today?
Look, they are clearly market friendly, and clearly markets, financial institutions, other institutions sensed a need for change. I think they're going to bring change. As I was joking, pre-election, this election was about whether you were more scared of 4 years of the same or more scared of 4 years of change. I think the verdict's been rendered. Market's verdict's been rendered. I come at this incredibly optimistically.
What type of changes do you think would unlock a higher market? I mean, what makes you so hopeful?
Look, we're coming in this administration is coming in at a point in time where they really do have an opportunity to pivot. Think about where the U.S. is in the world. I mean, all the action is here. I mean, just recite what's going on. The economy is in great shape, certainly relative to the other two large blocks of Europe and China. We have stimulated our economy over the past 4 years, and we're about to get the dividend of that. I mean, we forget 3 years ago, we passed almost $2 trillion for infrastructure. It's all under construction. 2 years ago, $52 billion for semi-plants. Not a single plant is open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, all under construction. 3 years in a row, we've been the largest recipient of foreign direct investment, all under construction. It's coming our way. We're where the action is, and now the question is, can we lead? And you can pick almost any area. Pick energy. We've spent all this time where the dialogue's been about energy transition. I think we're actually going to start talking about energy accretion. I mean, think of just the demand for data, for power, for data to help redefine our future. We can't just talk about transition anymore. We have to acknowledge we are going to need more power. No one produces clean power the way we produce it. We can have it produced here, or we can rely on others producing it for us. Financial services, I think we're going to see exactly the same sorts of changes.
How fast do you think the administration will move in loosening up regulations across industries?
We'll wait and see, but certainly the regulatory tone over the past 4 years has been difficult. I expect that the tone will be much more constructive to allow financial systems, financial markets, corporate markets to evolve to where the world is, not where the world was.
How much of a transformation will it be for the business of Apollo and others in the financial services community to get new regulators into the mix to make perhaps doing what you do easier?
Look, I don't think it's going to be massively different for firms like Apollo. I think certainly our industry has prospered over the last 4 years, just as we've prospered over the last 8 years. But I do think that there are really interesting opportunities, particularly in retirement, which is a conversation you and I have had previously. I mean, think about what we do. The largest pool of capital anywhere in the world is our 401k market, $12 to $13 trillion. What do these people invest in? Well, generally they're in daily liquid index funds for 50 years. Why? We have no idea. That's just always the way it's been done. Every place else in the world where the addition of private assets, the addition of other types of assets to retirement plans has been tried, it has resulted in better outcomes, and not slightly better outcomes, 40 and 50% better outcomes, Australia being a case in point. I think one of the upsides for our industry is a revisiting of this whole notion of public being safe and private being risky, potentially including into retirement solutions, which is what our country needs.
Is this the administration that finally helps to solve the retirement crisis? That's what you and I last talked about in Milken. I mean, can they move that quickly?
I don't think solving a retirement crisis is a 4-year plan. It is ultimately about putting in place a series of changes that will allow market forces over a really long period of time to solve retirement crisis. How do we encourage savings? How do we allow people to invest? How do we police it and create appropriate rules and regulations so that individual investors have access to the best solutions, but at the same time have protections if they are not as knowledgeable. It's going to be a balancing act, but I hope that we see the kinds of reforms that will allow a smoother path to retirement. Remember, superannuation in Australia is 40 years old. 40 years of compounding is just immensely powerful.
In the, in the prior Trump term, I think investors, many times they woke up and they saw a tweet move a stock price, and they saw a lot of moving activity each day from the president. Have you sensed, talking to the folks that you talk to, that this is an administration that will be different? Will this be a different 4 years than the prior 4 years? And has the president-elect, will he be a different president?
Bold forecast is not my area of expertise. I look at the people who he is surrounding himself with, and I come away very optimistic. I think this administration has a remarkable chance to really pivot the country, to take advantage of all the inherent positives that we have. I mean, imagine how powerful it would be if we actually got our act together and were well governed. It's truly unbelievable what we can do.
Does geopolitical risk pick up with this administration if we enact a trade war, for example?
Look, again, I don't want to veer out of my lane, but let's acknowledge, you look at markets are, at the moment, not pricing in much for geopolitical risk. There's very little risk premium. Valuations are high. Credit spreads are low. The thing we've learned is geopolitics is unpredictable. I don't see any reason, and this is a personal comment, not one from vast experience, I don't see any reason why this administration would have any greater geopolitical risk. Historically, geopolitical risk has come from U.S. weakness. Mm-hmm. The absence of a strong U.S. presence has resulted in more risk. So let's wait and see.
What did the current administration get wrong? Because I think a lot of investors have seen an infrastructure plan. Those things have started to move. Is it the regulatory environment that got too restrictive?
Well, let's look at it this way. We are, at the moment, running circa a $2 trillion deficit during relatively or record low unemployment and in peacetime. And so have we unleashed market forces to build for the future? Let's face it, our energy grid is changing. The need to get, yes, we can subsidize it, we can incent it, but the need for more power is evident. Those countries that build power, that support data, that support advanced data, advanced AI, advanced power are going to win. Those that don't are going to be left behind. This is going to be table stakes. Do we have a policy that allows us to do that currently? We don't. Look, think about employment. Employment has changed. People are no longer working for the same company, other than Apollo, of course, for the entirety of their career. Have we set up a healthcare system, a retirement system, and other systems that allow for mobility? And you go on, and you can be critical, but you can also say that we've waited too long to fix underlying problems, so that small amounts of tinkering are unlikely to result in directional change. I think what the market likes about what they're hearing is they're hearing directional change. The kinds of people that the president-elect has been able to surround himself with, I think, have been captivating for the market, and whether it's the Elon Musks or the others, bringing people who have a new way of thinking is likely to lead to different outcomes.
Can the administration cut taxes at the same time as the deficit continues to rise?
Yes, up to a point, but this is all about balancing act. Our financial situation is fixable. It is fixable in a way that is positive for the base that President-elect has said that he wants to help, but it is not fixable by small amounts of tinkering. It is about wholesale change, and we as humans, we are sometimes scared of wholesale change.
Oh, does Elon represent wholesale change? $2 trillion in potential cuts he's floated.
I think Elon Musk represents wholesale change, and I think we actually need wholesale change.
Interesting. So I know Apollo's focused, and you brought this up at your recent Investor Day, global infrastructure. How is Apollo playing in that arena? to help support that build out? I imagine AI is a big area of focus for the team.
Look, there are, we call it a global industrial renaissance. Think about what we're doing in the world. Almost everywhere in the world, we're building infrastructure. Today's article, there was an article today talking about European defense. And the most striking thing about European defense was how much infrastructure was required in Germany. So infrastructure is one of the things that we're building. We're doing energy transition because absent, there is no change, there is no going back. We are going to build alternative sources of energy, and companies are transitioning where they get and how they use energy. And the third is this notion of power accretion rather than just energy transition, I think is going to become part of our lexicon. We have vastly underestimated how much power we need. Which of us thought utilities was going to be a growth industry?
Or nuclear. Everybody's talking about nuclear.
In all forms. I mean, the irony that AI could actually be the cause of a renaissance in nuclear power, we just have to, kind of chuckle at that. But if you step back and you think about it, all three of these megatrends, this global industrial renaissance, are long duration, complex, and are generally ill-suited to shorter-term bank balance sheets or plain vanilla bond market. The amount of credit, the amount of hybrid equity, and the amount of equity that is going to be needed dwarfs anything we've ever seen from an investment point of view. Oh, by the way, the government's still running a $2 trillion deficit at the same time, and we have massive change in our financial marketplace. This growth in the need for credit, particularly complex, long-dated credit, is one of the primary drivers of our business. And I think that is going to power not just Apollo, that's going to power our whole industry.
How could we have a lot of avid investors watching live on Yahoo Finance in this audience. How do they get involved in this megatrend?
Look, I think they can get involved lots of ways, but I step back and I think about what we try and do as an investor and what we try to do as a company. So I ask really simple questions. Are we an asset manager? No. An asset manager can take any amount of money and invest it. We are in the business of excess return per unit of risk. We're in the business of alpha. Then you look out at the marketplace and you say, are valuations low? No. Are spreads wide? No. Okay, where am I as an asset manager in search of alpha going to go? And I look for places there are big inefficiencies where there are structural changes taking place. The intersection of the banking system and the investment marketplace and the need for long-term capital is causing capital formation to take place outside of the banking system and outside of the traditional bond market. Many investors have already pivoted here, the growth in private credit. But the growth in private credit is the tip of the iceberg. Private credit so far has been defined by levered lending and below investment grade activities. I actually think we're going to see an entire convergence of public and private in the credit marketplace. It may take time for that to happen, but it's coming our way. So investors who are positioned at this point in time, I think are going to earn excess return per unit of risk for a really long time.
Bless you. Are investors thinking about Apollo the wrong way? Look, Apollo is, of course, the parent company of Yahoo Finance. I mean, we always have known Apollo for big deals, but it sounds like you're about to unlock, or you have unlocked, a whole other growth mechanism inside the company.
This is about, so the answer is, I think investors have not thought much about Apollo, Blackstone, KKR, or anyone else in our industry. People are locked in a mindset of 40 years ago, which is private equity, as opposed to thinking about the industry as private assets. So think about the journey we've been on. 40 years ago, private was risky and public was safe. Private was three products: venture capital, private equity, and hedge funds, all three of which have risk, but used appropriately can offer good returns. And public was 8,000 companies, diversified portfolio of stocks and bonds. Okay, just a few years have passed. In fact, the entirety of my career. Is what we thought true? I don't think it's true. I think private is now safe and risky. Public is now safe and risky. But if you think about it, if something is risky and private, you stick it in a little bucket called alternatives. You watch that bucket really carefully. You demand really high rates of return. But if private is both risky and safe, maybe everything we've done from a portfolio allocation point of view before makes no sense. And that's actually what we're seeing happening in our business. The traditional role of privates in alternatives, private equity, venture capital, hedge funds, is there and growing. But the biggest trend in our industry is investors, individual investors and institutional investors, looking at their fixed income bucket and saying to themselves, why is this 100% public? Why don't I see whether I can earn some more excess return in public and private, and mixing alpha and beta? And the reason it's happening there first is investors don't need much of an education, because you have rating agencies who are capable of telling investors that something is of equivalent credit quality in the public market, equivalent credit quality in the private market. And this is what I expect to happen over the next 3 to 5 years. But make no mistake, it's not going to stop at fixed income. It's coming for equity as well. We will, as I've suggested, we will own, as investors, equity that is private rather than private equity. Because 8,000 public companies is now 4,000 public companies. More companies go private than come public. There is very little reason to want to be public other than for the largest market caps, given the
Who wants to do earnings calls, Marc? Nobody wants to do earnings calls.
Well, some of us like doing earnings calls.
You have to say that.
But it must be some bizarre personality defect that I like doing them. But
in the last minute and a half we have left, I remember talking to you 2 years ago, and your mantra, I guess, to the firm was that no new toys, meaning no big acquisitions. I mean, is 2025, with rates coming down, a friendlier administration, Apollo's back in the market for big new toys?
I won't say new toys. The absolute prohibition is gone. Christmas is back on at Apollo. Hanukkah, Christmas, whatever we need to do. But what I will say is we have to be very humble in what we do. At the end of the day, we are a small asset manager in the scheme of the world. If we hit our business plan, we will be twice our size in 5 years. We will still be a small asset manager. We are winning because of strategy. We are winning because of what we've done, but mostly we win because of culture. And to me, acquisitions that bring in lots of people, other than if they're essential to what we do, just put pressure on our culture. So I think you will see for us small additions to our capability through acquisitions, but I will be surprised if something transformational happens. We have so much to do in just our base business that it's some new toys now.
Okay, some new toys, 30 seconds left. How might people view the Apollo culture incorrectly?
Look, the folklore of 40 years ago is about private equity and sharp elbows and conquering, and we want 100% of everything. And I look at the shape of the business today. The business is about $600 billion of credit and about $200 billion of equity. In the credit business, if you own 100% of anything, it means you failed because you've originated something no one else wants. And I think we've come to the marketplace, and whether it's partnering with financial institutions like Citi, or it is partnering with companies like Yahoo, or it's partnering with other sponsors or other forms of financial intermediaries, we recognize that this is now a partnership. I can say jokingly, there are no permanent friends or permanent enemies. Some of our largest competitors are actually our biggest partners as well.